You opened an app. You asked for a quote. A number appeared. You assumed it was calculated from your age, your record, your history. It wasn't. That number was generated before you ever asked for it, built by a model, fed by data you didn't know you were giving. And the question isn't whether AI is pricing your life right now. It already is. The question is, what does it know about you that you don't? Every year, hundreds of millions of people request an insurance quote, a loan rate, a credit offer. They fill in the form. They wait. A number appears. And almost no one asks where that number came from. They assume it's a formula. Simple inputs, clean outputs. They assume there's a logic to it that makes sense if you just understood the math. There is a logic, but it's not the one they're thinking of. The model running behind that quote isn't measuring your risk. It's measuring your price. There is a difference. And by the end of this, you'll understand exactly what that difference costs you. Ask most people what goes into their insurance price, and they'll give you the same list. Age, location, driving record, claims history. These are the variables the industry has always advertised. The ones on the form. The ones that feel fair because at least you know about them. And yes, they use those. Still. But the model doesn't stop there. The form is the front door. The model goes around the back. Modern risk pricing. AI is trained on thousands of variables, many of which have nothing to do with what you've actually done. They have to do with what you're predicted to do, based on what people like you have done before. In the United States, most states allow insurers to use your credit score as a pricing input. Not your claims, your credit. A measure of how reliably you pay debts is being used to predict how likely you are to file a claim. The research connecting those two things is disputed at best. The practice is legal. But credit score is just the beginning. Purchase patterns, the categories on your bank statement, gym memberships, organic grocery spend, subscription services. In some models, your browsing behavior, the searches you made at 11 p.m., the symptoms you looked up when you thought no one was watching. Postcode clustering, not just where you live, but which streets, which blocks, which side of the zip code. The model doesn't ask who you are. It asks, who does your data say you are? These models are trained on historical data, millions of past policyholders, their data profiles, their eventual claims, their costs to the insurer. The model learns the pattern. It learns which data signals, credit behavior, location, spending, correlate with high claim costs. Then it looks at you. It finds your signal cluster, and it prices you accordingly. You have never filed a claim. That doesn't matter. The model isn't evaluating your history. It's evaluating your resemblance to people who have cost money before. You are not an individual in this system. You are a cluster, a probability, a predicted cost. And when did you last check which cluster you've been assigned to? ProPublica investigated insurance pricing across major US cities. They found that in some zip codes, predominantly black neighborhoods, premiums were up to 30% higher than in white neighborhoods with identical risk profiles. Same driving record, same age, same claims history. Different postcode, different price. The insurers didn't program discrimination into the model. They didn't need to. The training data was collected from a society that was already unequal. The model learned the patterns of that inequality and reproduced them, automatically, at scale. The model doesn't have intent, it has outcomes. And those outcomes follow the exact same lines as the systems that came before it. But here's the part that changes how you see every quote you've ever received. Insurance is not a charity. It's a business. And a business has one core objective: revenue. The model's job is not to correctly assess how risky you are. Its job is to charge you the maximum premium you will pay before you walk away. This is called price optimization, and it is exactly what it sounds like. The model tests price sensitivity. It identifies customers who are unlikely to shop around, who have been with the insurer for years, who are less likely to complain, and it charges them more. Not because they are riskier, because they are less likely to leave. Several US states have banned this practice. Most haven't. And globally, the regulation is years behind the technology. The model is not broken. It is performing exactly as designed. You are just not the customer it was designed for.
In 2021, a woman in Chicago received a mortgage rejection. Her income was sufficient, her credit score was good, her employment history clean. The rejection cited risk modeling. No further explanation was required by law. She was 34. She was a nurse. She had no debt. She wasn't rejected by a person. She was rejected by a model that found her cluster insufficiently profitable to lend to. She never saw the model's reasoning. She had no legal right to. She was, in the language of the system, a pricing decision, not a person, a predicted outcome. Her story is not rare. It's common. It just rarely has a name attached to it. 7 of the top 10 US life insurance companies are actively using wearable data in their risk models. Your steps, your resting heart rate, your sleep patterns, your 3 a.m. activity, smart home devices, the thermostat setting that signals you work night shifts, the doorbell data that shows how often you leave, how late you come back, telematics in your car, speed, braking, time of day, roads taken, social signals. In some experimental models, the emotional tone of what you post online has been tested as a risk input. You generate this data every day. You generate it right now. And the model that will price your life next year is being trained on the data you are creating this morning. There is no single model. There are thousands. Insurance companies, mortgage lenders, credit card issuers, employers running background screens, landlords running rental algorithms, each one running its own engine, each one pricing a slightly different version of you. And they don't share their methodology. They are not required to. You cannot request your risk score from most of these systems. You have no legal right to see the variables that priced you. In most jurisdictions, you have no right to an explanation at all. The decision was made, the model ran, the output was generated, you received the number. The reasoning stays with the engine. The model is getting more precise, more data, more signals, finer clusters. And as it gets more precise, it does not get more fair. Precision and fairness are not the same thing. A model can be extraordinarily accurate at predicting which cluster you belong to. And that cluster can be built on a foundation that was never neutral to begin with. The AI did not create this inequality. It inherited it, then automated it, then scaled it to hundreds of millions of pricing decisions per year. You have a price. You have always had a price. The difference is, now a model calculates it in milliseconds. The system doesn't need you to understand it. It just needs you to keep paying. The question is whether you will, now that you've seen the engine.